Hi friends, welcome to EduTap. So welcome to the Target RBI Grade B 2018-19, a video series brought to you by EduTap. Now as part of this series, EduTap shall be coming out with a video each day, and this series is going to be helpful for those who are going to appear in 2018 RBI Grade B examination as well as for those who are going to appear in the 2019 examination. So friends, what shall be provided as part of this series? So as part of this series, we shall be either coming out with 5 MCQs a day discussion, or we may also come out with the explanation of certain terms and concepts, or we can also club these two and come out with the terms and concepts and then come out with 5 MCQs pertaining to the concept that was in discussion, right? We may also come out with certain orientation or strategy video, or we may discuss the previous year questions. We may also analyze the syllabus or the cutoffs, the patterns, or we may have live sessions also as part of this particular series. So friends, the theme for today's lecture, what is it? So basically we're going to deal with certain terms, or basically if I would rather pinpoint, we're going to see an important principle that comes under income statement, right? So this particular theme that we're going to study about today is relevant to the finance and management paper, and you cannot find the exact topic mentioned in the syllabus with regard to the income statement, but you might find some questions related to this topic as well in your paper. So we shall be looking at it from a fresh perspective. So friends, before we begin with today's lecture, I would just like to mention that this particular lecture is going to be more helpful for those who are going to appear in the 2019 examination, because those who are preparing for 2018, by now they would have actually encountered these terms while preparing for the examination, right? But still it can act as a revision for those people who are already well aware of these terms that I will discuss today. Right? So basically, when we say income statement, okay, it comes under the broader category of financial statements out here. Okay, so there are three financial statements basically. One is your income statement, then you have your balance sheet, and then you have your cash flow statement. Okay, so kindly keep these three things in mind. Okay, so first thing, why do we actually require these financial statements? Whenever we have certain documents, there's always a purpose for it, right? What purpose do these financial statements serve? Right? So this is a question. Now, very bluntly speaking, it is actually used to assess the financial viability of any firm. Okay, so this is the motive behind using these three financial statements, or we can rather say the prime motive behind these statements. Okay, so now when we talk about viability, what does it mean? It means the ability to survive. Okay, this is the basic meaning of this term. Now, when you use it in a business sense, we are checking the viability of a particular firm in terms of its financial performance. Okay, now if I want to check whether a particular firm is earning enough profits or is it able to meet its bills, right? I want to check whether a firm has enough cash in its hand. So where do I find all these data from? When I assess all these three financial statements, I would get a clarity, I would get a clear picture as to how a firm is actually performing, whether it is going in loss, whether it is earning profits, right? If it is spending money, where are the areas it is spending money in, right? Is it going the right way? Is it going the wrong way? Now, how does it help? Suppose if there's an investor, that investor would definitely want to know some important stats about the firm in which he wants to invest. Okay, so these are some of the very basic things that are required. Okay, so now what we shall be doing is we shall be first seeing what is this income statement. Okay, so friends, here if you talk about this particular statement, it is also known as a earnings or a profit loss statement. A very simple term if you say whatever you're earning and what you are expending. Okay, so there is going to be a tabulation of both these things, and then you're going to arrive at a conclusion whether you are running in profit or you are running in a loss. So basically it's a profit loss statement. And when you talk about the period, which it covers, it can actually be a quarter or it can be a year. So you can prepare an income statement that is related to a particular quarter of a year, or you can prepare an income statement which is related to a year on the whole, right? When I say quarter, to those who are unfamiliar with it, in India, if you take the financial year starts from April 1st and it ends on March 31st of next year. Right? So if you take this entire year, it is divided into 4 quarters. Okay, so the first quarter being April, May, June. Okay, and the second being July, August, September. The third being October, November, December, and the fourth quarter being January, Feb, and March. Okay, so even we are dealing with these basic things because for some people who have just started out with their preparation, it is going to be immensely helpful. Okay, so when you talk about income statement, it is basically a profit loss statement. And as we know that profit is when your revenue exceeds your expenses, and you're incurring a loss when your expenses are actually more than your revenues, right? So friends, in today's lecture, what we are going to discuss is certain principles that are actually used while accounting the income statement. Okay, so basically talking about the principles, there are two principles that are involved. The first one is principle of accrual accounting and cash accounting, and the second is the categorization of the expenses into operating, financial and capital expenses. So today what we shall be seeing is the first principle regarding accrual accounting and cash accounting, and the other principle we shall capture it in the next lecture. Okay friends, so now we have come to the main discussion of today's lecture, that is the principle of accrual accounting and cash accounting, right? So what we need to do is we need to appreciate the difference between these two terms to understand what they actually mean, right? And to help you guys understand what are these principles, let us just take a practical example so that it becomes easier for us to understand the basic concept. Okay, so in our example, we are taking a firm or a company A and a company B. Okay, so company A basically manufactures raw materials, and in our example, let us imagine that they manufacture a cloth. Okay, and company B is a manufacturing unit. So what it does is it gets the raw material and it manufactures garments. Okay, so now just in case, just imagine that these two companies have been in association for a long time and they have been doing business for long. Okay, now to just understand this better, just take 2 quarters, that is April to June, and the second quarter July to September. Now we need to assume that both these companies A and B prepare income statements quarter wise. Okay, so in April to June they prepare one income statement, then again July to September, and it goes on. Okay, so what has happened is, let us consider a situation out here. So what is the situation? So company B actually requires a certain raw material for manufacturing the garments. So it approaches company B and places an order for raw material worth rupees 50 lakh. But what happens is company B tells company A that it is presently facing a cash crunch, and so it would not be immediately able to give the cash to company A for the raw material that it has received. Okay, since they have been working for a long time, company A is okay with it and it actually dispatches raw material worth rupees 50 lakh to company B. So what has happened? Company B has dispatched the raw materials. So company B has received the raw materials and company B says that it would make rupees 50 lakh payment when it actually has money in its hand. Okay, so these are the two things that are happening between company A and company B. Okay, now let us come to a situation where this particular quarter is over, April to June. Now company A is starting to prepare the income statement. Okay, so we are going to consider two situations out here. So situation one. Situation one is that company A is actually using the accrual accounting method. Let me keep it as AA. Okay, so because it is using this accrual accounting method of preparing this income statement, what it would do is it would make an entry in its income statement saying that it has received rupees 50,000, or you can say payment receivable. Okay, we're not going to go to that term in this particular lecture. So you just understand that it is going to make an entry of rupees 50,000. Now you would wonder that it has only delivered the raw material worth rupees 50 lakh. I'm sorry, I've been saying thousand, it is lakh. Okay. So we might be wondering that, it has actually just delivered the goods or the raw materials which were worth rupees 50 lakh, but it has actually not received the payment for it. But because it is following this accrual accounting method, what happens in this kind of accounting method is the moment you have provided a service, or the moment you are delivering the raw material or the goods, you make an entry assuming that you have received the payment. Okay, though you haven't received it physically yet. Okay, now we are going to go to the second scenario. Now the second quarter starts, and what happens is in the month of July end, company B gives the payment of rupees 50 lakh to company A. So finally, company A has received the payment in the month of July. So what happens after the end of this quarter, company A is making the income statement again for this July to September quarter. Now just understand that we have changed the situation. Okay, so switch over from first situation to the second situation. So in second situation, what is happening? Company A is following the cash accrual method of accounting. Okay, so in this situation, what happens is company will not put this entry of rupees 50 lakh in April June quarter. No, what it is going to do is it is going to make an entry of rupees 50 lakh only in this July to September quarter. When company A physically receives the payment in its hand, it is going to make an entry in its account books because it is following cash accrual accounting method, cash accounting method. Okay, now you need to understand the difference. What is happening in the first situation? In the first situation, it would immediately go and enter this rupees 50 lakh received entry in the April June quarter. Okay, because the goods have left its premises. But if it is following the cash accounting method, it would not include it in this April June quarter. Rather, it would wait till the payment is received, and in the quarter in which they receive the payment, in our example, they are receiving in July September quarter. So then they would go and make this entry in that particular quarter. Okay, to make the things more clear, let us take company B. Now, both the situations we are going to see for company B also. Now, what is the first case? First case is it is following accrual accounting method for preparing income statement. So what would company B do in this situation? In the income statement, in the place of expenses, it would make an entry of rupees 50 lakh in which quarter? It would do it in April June quarter itself. Has it made the payment yet? No, it hasn't made the payment yet. But what has happened? It has received the raw material worth rupees 50 lakh, and it is actually liable to make the payment to A. So what it does is it accounts these expenses in the April June quarter itself. Why? Because it is following the accrual accounting method of preparing the income statement. Now come to the next situation. Now start afresh. It is following which method now? It is following cash accounting method. So now what it would do? It would not make the entry of rupees 50 lakh in the April June quarter, but it would go and make this entry in the July September quarter. And why is it so? Because only in the month of July has company B actually made the payment to company A. So it is going to make this entry out here in July September quarter. So this is the difference between these two accounting methods. So now you would be able to appreciate the line which you see on your screens, that the difference between the cash and accrual accounting actually lies in the timing of when the sales and purchases are recorded in your accounts. Right? So just now, if you have really understood the example, you would be able to clearly differentiate and understand the word timing that is used in this particular statement. So here, let us go line by line. So just come to accrual accounting. The revenue from selling a good or service is recognized in the period in which the good is sold or the service is performed, okay, and not when the payment is received. Now you relate the example that we were discussing. So basically, company A sold the goods to company B in April to June quarter, right? So what they're doing, they are making the entry of receiving the payment in this particular quarter, and they are not doing it when the payment is actually going to be received in hand. Okay. Now, if you see cash accounting, the revenues are recognized when the payment is received. So if this company A followed the cash accounting method, then they would not have made the entry of rupees 50 lakh in April-June quarter. Rather, they would make it in July to September quarter when they actually receive the money physically in their hands, right? So this is the difference. Now coming to expenditure, expenses are recognized when they are incurred rather than when the actual payment is made. Now take the example of company B out here. So what company B, if this particular company is following the accrual accounting method, they would actually include in their income statement the expenses in April to June quarter. Okay, but if this company B is following the cash accounting method, then they would make the entry of this expense of rupees 50 lakh in the July-September quarter. So you can clearly see the differences. If you're not able to understand, kindly pause the video, hear the example again, and correlate with the definitions that is mentioned out here, right? So friends, what are the courses that EduTap has to offer for RBI Grade B 2018 and 19? You can have a look at the screens. These are the courses that we offer for NABARD and CTET, which has been launched in association with GradeUp. Now, if you want to know more about our courses, you can visit our website www.edutap.co.in. You can also drop us a mail at hello@edutap.co.in, or you can also give us a call at 8146207241. So friends, we shall soon be coming out with an interesting course for UPSC, so kindly stay tuned for it. Now with this, we have come to the end of this lecture today. So basically we had an insight as to what is the use of this financial statements, what are the three financial statements, that is income statement, balance sheet and cash flow statements. Then we had seen what is specifically income statement, and usually whenever accounting is done as part of preparing income statement, there are two principles that are used, right? One, if you see, the principle of accrual accounting, and then the cash accounting. So we had seen what are these two principles and what is the difference between these two, right? In the next part of the video, we shall be going ahead with understanding the next principle of differentiating the expenses. Okay, and if you found this video useful, kindly like, subscribe and share, and the PDF format of this particular video is available on EduTap's Telegram channel. The link for the channel is placed on your screens. Till then friends, thank you so much and happy learning.